The past quarter has been an eventful time, particularly across the political and macro spectrum, most notably in the world's largest economy, the US. This has no doubt created some uncertainty for investors, but at Montaka, we remained firmly focused during the quarter on the long-term potential of the highly attractive and exciting opportunities in our portfolio. Now, while we regularly discuss our core investments at length, such as a Microsoft, an Amazon, Alphabet, Blackstone, and KKR, we are also seeing significant upside potential in other holdings, such as a floor in Decor. So this is an advantaged hard surface flooring specialty retailer set to benefit significantly when the US housing sales cycle finally turns. Or take DoorDash. This is the market leader in the US online food ordering, delivery, and merchant marketing services with numerous vectors for long-term growth. Then there's LVMH. Despite its irreplicable brands such as Vuitton, the global luxury giant can be acquired today on a very depressed multiple of temporarily depressed earnings. Then there's MongoDB. With arguably the most flexible enterprise-grade database for unstructured data, investors are underappreciating the strength of the company's position in the context of AI. So in all of these cases, we expect future earnings power and future stock prices to be much higher than they are today. There is no doubt that the global equity markets at the moment are complex. It means that more so than ever, investors must carefully apply first principles thinking when making assessments. And this is particularly the case when using price to earnings ratios or PE ratios to assess both the overall market and individual opportunities. The PE ratio of the S&P 500 is high by historical standards, and many investors are therefore feeling cautious about equities. But there are a lot of things that can influence the PE ratio. So for example, growth expectations are above their long-term average today, so this will help to push the PE ratio above its long-term average. Interest rate expectations are below their average today, so this will also help to push the PE ratio above its average. Even credit spreads, they are below their long-term average levels today, and this will also help to push the PE ratio above its long-term average. So all in all, it's probably right for today's market-wide PE ratio to be above its long-term average. Maybe it's a little over fair value today, but it's probably there or thereabouts. So look, just to be clear, we are not arguing that equities are generally cheap today. We are instead seeking to use first principles analysis to clarify historical comparisons. We are seeing cases of both prudent and blind faith capital allocations in the rapidly evolving AI supply chain, and this means investors need to make careful case-by-case assessments. Starting with the prudent, so some companies are investing enormous sums of money into AI and already earning significant returns. So given the strong complementarity AI has on their existing core businesses, Meta Platforms, Alphabet, and Tencent, these companies come to mind. And by the way, check out our quarterly letter for a case study on Tencent and why we see a particularly long horizon of growth ahead for this business. On the other hand, some capital allocation decisions and forecasts are really starting to stretch credulity. So what we've seen over the course of the last 6 weeks is a litany of mega partnerships announced by OpenAI. So in the space of 6 weeks, OpenAI has penciled in an incremental 20 gigawatts or more of AI data center capacity. This is enormous. To put these numbers into perspective, in the Western world, each 1 gigawatt of capacity costs about $50 billion. And OpenAI has just announced that they believe they'll have demand for more than $1 trillion of required investment into AI data center capacity. So these are really, really big numbers, and they might turn out to be right, but what we're a little bit concerned about is that we're not seeing that much discussion about the revenues and earnings that OpenAI will need to generate in order to satisfy the returns that will be required on such investments that are being made. Questions such as, what products is OpenAI selling, to which customers, at what price, What are competitors offering? These are the questions that should be asked today. We're not seeing much of it, so we do have some concerns there. Montaka made one new investment early in the September quarter, and that was in DoorDash, ticker DASH. DoorDash is the overwhelming US leader in online food ordering and delivery, and increasingly DoorDash is evolving into a critical marketing and commerce platform for merchants of all kinds, but particularly restaurants. If we look at DoorDash through the lens that Montaka uses to evaluate opportunities, the company is the undisputed winner in a very large winner-take-most US market. The company has numerous adjacencies and exhibits several flywheel dynamics that over time will likely strengthen the company's advantages. So such as, with the most users on the platform, merchants are attracted to it. With the most merchants on the platform, users are attracted to it, as well as delivery drivers. With the highest delivery driver density in the network, services are the most timely and reliable, creating the best user experience, which further aids retention. With DoorDash's loyalty program, users receive substantial rewards that encourage repeat usage. With the most users and the best driver delivery density, new verticals are successfully being laid on, such as grocery and packages. And then importantly, with all the first-party user preference data, high return on investment marketing services can be offered to merchants to drive incremental customer acquisition. So like Spotify, for instance, DoorDash has spent more than a decade incurring losses to build out their platform and the leading market position and building up the momentum in these flywheels. And while the business only turned profitable last year, we see its current earnings power being at just but a tiny fraction of what the future earnings power will be. The company's incremental revenues are coming in at profit margins substantially higher than the profit margin on its existing revenue base. So like a Spotify, DoorDash is an established business of the future and reflects one of the substantial changes that is taking place in how consumers shop for food, groceries, and other local products. And while DoorDash's PE ratio, it appears high, but this offers limited insight when viewed through a first principles lens, especially given the high probability uplift of future earnings power from current levels. Montaka's top 10 investee companies at quarter end are showing on the screen now. We remain highly concentrated with our 10 largest holdings accounting for 74% of Montaka's total portfolio. For newer viewers, we invite you to explore our latest insights and thematic analysis at montaka.com/blogs, where you'll also find clear information as to how to invest with us. For what it's worth, our most popular investment vehicle is quoted on the ASX under ticker MOGL, and this can be purchased simply through your standard brokerage account, just as you would any other ASX listing. Well, thank you very much. As always, we'd love to hear from you, and please reach out with any thoughts, comments, or feedback.